Yeah. All right. So Elite Wealth Management, we're so glad y'all are here. Basically, this is our monthly update. It'll talk about your portfolio plus some planning ideas. Please make this interactive and talk to us either in chat or just interrupt me. That is absolutely fine. But today's agenda always start with a investment planning conversation. So what are we doing with your portfolios? What's our investment team saying? Where's some of the investable ideas? Then we try to throw out a planning idea, which this month we're going to combine with relationship management because we're going to talk a lot about taxes as well as a new program we have called Holista Plan. And from that planning idea, and I just want y'all to know this service is available. That is a new software we have where if we upload your taxes and AI, I tell you what, it is changing our business more over the last 6 months than I've seen it do over the last 10 years. It'll give us some great information and then also let us run some future scenarios, based on things like Roth conversions, charitable gifts, gifting to kids, estate tax if that goes down that, previously we've been unavailable to do. And then introduce you guys to Kat Career, our newest advisor and a trusted CPA friend of the firm for many years. So let's jump right into investment planning. And of course, you guys all get our wonderful disclosures here. So please screenshot this in case you want to read them later or need any help falling asleep. So market outlook. So let's look at this. So here's just kind of the summary. I'm not going to read this all to you guys. Y'all can read it, but do want to talk about some of the investable ideas here that jump out at me. First of all, interest rates. There's been an expectation, and we'll look at this later on a few charts of interest rates going down. But whether they go down or just stay the same, there doesn't seem to be much interest in raising them much higher. And to me, that is a good thing because it kind of says the economy is going to stay at about this speed, the market's going to stay at about this speed or better, and there's not a lot of concern here. Also, with inflation declining, that backs up that point even more. Now, of course, we do have heightened geopolitical risks, and we are doing a presentation, which we'll bring some of those slides into this presentation in the future, but it's on investing during an election year. And one of the things we looked at is how many geopolitical risks have been there in the past versus now. And the truth is, as much as it seems like there is now, and there is a lot, it's not that much more than has been there in the past. And there have been times in the past that actually looks much, much scarier than right now. And then finally, and I think this is a really great point, and I'm going to highlight this right here, the bond market. So whether you're holding cash on the sidelines or not, the bond market, now that it has higher yields, is starting to attract money out of cash accounts and over to fixed income. And that's a very positive thing for the bond market. So that's something we're definitely looking at, along with, how are we going to do it from a duration perspective and a quality perspective on the stock portfolio. All right, so from an economic update, and I thought this was great just because we talked about election years earlier and the geopolitical risks and things like that go with it. But let's just talk about average returns for the stock market. And the reason I throw this up is not to say this is what's going to happen, but saying there's no numbers here that scare me. A lot of people feel like, oh my gosh, if so-and-so gets elected, we might go down in value. If this other person gets elected, we're going to go up in value. And it's really just not true. And in fact, what you see is some of the best returns, and there's probably some correlation here, but we're not sure, are often non-election years. But even in a presidential election or a midterm election year, you still have net positive returns, which is positive, data as far as we go into this year and the next years to come. And, what it really helps us with is looking at the past, how do we coach you for the future? And in the future, do we need to be concerned when these, political situations are happening in our country, whether it be, we might have a government shutdown, we might have an election going on, we might have, Congress not all that functional with each other, but the market still goes up. And the main reason for that is it pays attention to the companies, and also it pays attention to the economy. And if you look at this, one thing we have found is GDP has been surprisingly strong. You can look at the last few years, and of course, you have to remember anytime you look at year-over-year economic data, where you were the previous year. So, I'm sorry. For example, we got these big numbers in 2021. That really doesn't tell us that much because 2020, they were so negative due to COVID. But then you see where there might have been an actual recession where they cut down here. And then you see them now starting to grow back and really get to a point of, I would consider it normalization. Not necessarily good, not necessarily bad, just simply normalizing. And then the jobs market, of course, you have to look at that under two ways, wage growth and unemployment rate. And I tell you what is weird about this chart. If you look at this deviation right here, when you have wage growth going down, but unemployment rates going up or staying high, that really is actually kind of good for business, because what that means is they're having to pay people less to get them into the market. What actually can be hard for businesses is when they can't find labor or they have to keep raising wages. And you look at this area here where it was very tough for businesses, where actually wage growth went over the job unemployment rate. And at that point in time, that actually slows down the profitability of corporations and other companies you invest in. So it's not saying that unemployment being high or low is necessarily good. There's kind of that, Goldilocks sweet spot, and we're getting really close to being in it. In addition, consumer confidence is picking back up, which, a lot of us have been watching the economy for several years and realize the consumer is really what's kind of keeping it alive. And yet again, Americans love spending money. So with all these things in the backdrop, I showed you the overall outlook for 2024 earlier. Here it is as far as equities specifically. So monetary policy, obviously, the more dovish the Fed seems, the better we can invest in things like growth stocks, for example, that don't have a lot of earnings now, but will in the future. Also, it's starting to surprise our committee, a lot of economists, and several other people, this idea of the soft landing. It really looks like it's going to happen. And then finally, geopolitical risks are definitely present, but they appear contained from the standpoint of impacting our markets. I'm not going to say they're necessarily, contained from the standpoint of, whatever's going to happen in the Middle East, whatever's going to happen between Russia and Ukraine, but they don't seem to be impacting our markets all that much right now. So I will just pause for any thoughts and questions here before we go into some fixed income and some other data.
How does higher for longer factor into your thinking, David?
Yeah, certainly from a bond standpoint, and we'll get to that in a second, it is that going longer on duration is, or more the mid-range on duration is still something we want to avoid a little bit. And then also, as much as, you want to kind of believe in some of these growth stocks, a lot of times, higher for longer gives a little while before they might take off. And, I'll often tell people, and I appreciate the question, it's a very smart question. It's easy to tell people what will happen in finance. It's nearly impossible to tell people when it will happen. And that's my comeback on higher for longer is, yeah, it's going to be higher, but I don't know when it's going to go down, but I have no reason to think it's going to be higher than it is now. And I'd love to hear anybody else who has different thoughts on that, because I'm certainly not, I don't have the perfect crystal ball here. All right, well, let's keep going here. All right, so here's an interesting thing when we think about the the market in general and valuations especially. So we showed you our thesis here, which if you look at this, there's a lot of investable ideas here. There's a lot of, places, for example, a diversified and balanced exposure can get us. When you actually look at the indexes right now, they're not that overvalued. And in fact, they're actually kind of affordable, except for the Magnificent Seven stocks. So, Meta, Amazon, Apple, Alphabet, Nvidia, Microsoft, and Tesla. You look at how they have done since 2020, and it's unbelievable. I mean, this is, historically better than average, as well as some high valuations. But you look at the rest of the NASDAQ and the rest of the S&P, and you realize that, okay, in the S&P 500, for example, there's about, 490 other companies out there that we can invest in at a pretty decent price. And so two things. One, not to make any excuses on why you might have underperformed the Magnificent Seven, but, when you believe in diversification, we're actually going as far as saying, you might want a more equal weighted index instead of a cap weighted index because of this chart I'm showing y'all right here. And that's also giving us the conviction of either certain active managers or even going towards ETFs and mutual funds that maybe focus on the value side of the market. And then, because when you look at the Magnificent Seven, they are more established growth companies. When you look at the NASDAQ down here, these are newer growth companies. So back to John's question, these companies right here will take off when rates start going down. I'm not sure that'll impact these much. And so I think you're going to start to see an outperformance of other stuff. And if you don't, oh well, rebalancing. And the most important thing we can do here is use some discipline and principles of investing to make a good long-term decision. All right, and then also wanted to show this is just a quick, where are we coming from? And the reason I'm showing this, it has a lot to do with how people's financial plans look right now. And I have, looked at plans in a lot of situations, and I will tell every single one of you, when you look at your Monte Carlo and you look at your projections, when you're at the end of these bull markets that you're seeing, and this is showing how much they went up during those bull markets, those numbers look better than they really should. When you're at the end of these bear markets, those numbers look worse than they really should. And so we do have to keep a mindset towards the long term as well as balancing those out. But one thing you can look at when you see this is how much longer the bear market or the bull markets are than the bear markets, and how much bigger the bull markets are than the bear markets. And this is why even if you have one or two bad years, over the long period of time, investing, buy and hold with equities, it just works. So, watch those numbers start coming back. They really have towards the end of last year, and have some patience with that. And then let's go into bonds. Earlier we were asked about higher for longer. And, certainly with fixed income, interest rates are basically a mathematical force on them. So with equities, if you think about interest rates moving up or down, you can't, with a calculator, say exactly what that means it should do to a stock. And the reason for that is with stocks, the business plan, sales, consumer sentiment, all these things matter a lot. With fixed income, as long as you can pay that debt at the end of the day, these are very predictable investments. In fact, very mathematical investments. So if monetary policy is expected to ease from current restrictive levels, but rates remain elevated, meaning higher for longer, where do we want to position ourselves? And the reason we're saying shorter duration is there's actually still an inverted yield curve, which our belief and a lot of economists we're listening to is not that that's predicting recession, it's that that's predicting basically when inflation will ease. And at that point in time, it makes a lot of logical sense, which, we'll look at the futures market in a second. I think that's true. And then slowing growth, which is actually good for bonds, not necessarily good for stocks. So, my takeaway from this slide is I think you guys now have opportunities in fixed income that just haven't been there in over a decade. And so, let's get excited about having that in there. Not saying it's going to do better than stocks, but I definitely think we have a good thesis to say it'll do better than it has in the past. And then, we talked about the interest rates coming down. Here's what the futures market is predicting. They are definitely predicting a quick decrease, probably quicker, in my opinion, than the bond market. But both, if you look at the curves on them, seem to be predicting rates going down at some point, whether it be later this year, soon, or next year. But no one's predicting, an increase at this point. Also, let's talk about bond volatility. We do think that's going to remain high because of interest rate expectations going down, people buying on that, and then stuff maybe having to come back up if that doesn't happen. But the yield's there to cover it now. So you can have some fluctuations in price on your bonds and still have the yield and the coupon come over and cover that. So in general, when you look at where we are from a risk off and risk on perspective, we're leaning a little bit more towards the risk off right now. However, we are not, we're not in the warning area at all. We're just in more of a, when you get up here at risk on, it's more of a, all right, where are the opportunities? Let's go opportunistic. When you go risk off, you say, how do we go defensive? Anything in the middle, it's really more of a, let's diversify and see which way this moves. And then I thought this was interesting, talking about interest rate movements. And this shows you on the left side what would happen, because we talked about if rates go up versus down, or if rates go down versus up. It's showing you on the left side here, if rates went up by 1%, what would happen to the principal price of these fixed income assets? But then it's showing you on the right-hand side, if rates go down by 1%, what will happen to these fixed income assets? And you can see some huge potential gains, which is why let's look at, for example, a 10-year treasury, okay? If you told me 10-year treasuries are earning about 4%, but I can get, 5.5% in a CD, which should I invest in? Obviously, 5.5% is better than 4%. However, 4% isn't losing money. And if rates go down 1% in a CD, you're still getting 5.5%. If rates go down 1% and you're in a 10-year US Treasury, you're going to go up by almost 12% plus your yield. So that's a 16% total return. So it's not necessarily a gamble, but I would call it a prudent risk to favor fixed income over, just yield. Any thoughts and questions on that? I know that's kind of a heady concept. Keep going here. And then also wanted to show this. This is kind of a real, I just thought this was fun, quite frankly, because, so many of you guys I talk with are in this exact same situation where you have a mortgage rate that's so low, you might want to move somewhere, but to buy a new house would be super expensive. And then also, do we pay off that mortgage, or do we, invest somewhere outside? And that's always a good debate. But one of the things that jumped out at me on this is just how many people have mortgages below 4%. And so you're looking at, percent of balances and, the number of people that have it. And very few people, and of course it's not zero out there, but if it's less than 1%, are borrowing at these higher rates. So what this is really showing me, and I ran into a guy the other day who was a mortgage broker, and this isn't the funnest time in the world because no one's refinancing, but what it really showed is these rates are impacting the housing market, whether it be people are holding or people are, not able to buy. And I really think the way they're impacting the housing market, for better or worse, isn't necessarily that home values are going to go down, but it's making it harder and harder and harder for people to get into that first home or second home and really, go go up market on that, which got pretty easy for a while. So, unfortunately, that's a situation if you have kids and grandkids trying to get into the market for the first time. But otherwise, y'all are in a pretty good place if you have that refinance down, and might impact your downsizing decisions, but certainly not going to hurt you where you're at. And then finally, this is looking at total return of the Bloomberg Ag. And what was amazing is not necessarily how this has been, but how this was last year. And it really started to show us that, bonds on the whole are taking off. In fact, in January gave us their largest monthly total return performance since 1987, which is pretty big. And if I don't think Juliana's here anymore, but I will pause real quick and see if anybody wants a prize, and I'll write your name down if you answer this. Why is 1987 a significant number or significant year? Whoever answers first, I'm writing your name down. You're going to get $20. Great size ever. All right, you guys aren't talking. You're just putting it in chat. All right, well, I will go on back. So I get $20. Cool. No, actually, I think somebody did. They said highest rates ever. That's not necessarily what I would say, but it's kind of correct. It was the Black Friday where the stock market dropped like 25% in one day. And believe it or not, within 3 months, it had already made its money back and come back into the positive. But when you look at that, what you see is, certainly in 1987, bonds were a huge risk-off trade. So a lot of money flowed into those, probably more than should have had that black swan event not happened. But now we're getting just as good of returns, if not better. So, and it's more on a natural economy. So that's why that number stands out quite a bit. If anybody got that, that was pretty good. All right. So I'm going to pause for any thoughts and questions on this investment stuff. And then we are going to jump over to Kat, and I'll give her a nice introduction. Anybody?
By a bunch.
That's right. All right. We will jump back in. Apparently, no one's concerned about their investments. And I will say, you guys, when the market's down, y'all talk a lot. When the market's up, y'all just all seem happy. So I hope you guys can enjoy your afternoon after this. But all right, let's jump into this. All right, we're going to skip planning this month because we did glamping last time anyway. All right, so Kat Greer, let me introduce her, and then we're just going to have a little bit of a conversation, let y'all ask questions. Already saw one that Ricky wrote in, so thank you for that. So on relationship management, what we really mean by that is helping you coordinate your professionals, whether that be CPA, P&C advisor, your estate planning attorney, us, whoever else is needed in that real estate, things like that, but also just, helping with things from a three-dimensional perspective. And from a three-dimensional perspective, I cannot tell you how excited I am to have Kat Greer join our team. She's a CPA we've worked with for a number of years. Her and I share a background of going to grad school together, and she went the tax route. I went more of the investment wealth management route. And, we just bring a very nice combination of knowledge together. And I'm really hoping that can serve y'all better. I mentioned the planning idea at the beginning about Holistaplan, that tax planning software, which at least for me changes the game. I think for Kat, she could just look at your returns and do all this stuff. But we're really trying as much as we can to add more and more services. Possibly next month we'll even be talking about some cybersecurity stuff, which might be a great service. But with Kat, let's welcome her to the team, and I'm going to go ahead and stop sharing, and we'll just have a little fireside chat here.
That sounds great. Dave, thank you so much for such a warm introduction. I'm glad to finally get to be a part of these, these meetings. We talked about it for a long time, me joining. Of course, I was always in tax season or, working, under deadline. So I wasn't able to join. So I'm glad to kind of be a part of it now and be part of the team with David and Merritt. Like you said, we've worked together for a long time on a lot of mutual clients. He's one, not blow smoke up his butt, but he's one of the best advisors I've worked with. And I think we make a great team, and I think Merritt's one of the top in the industry. So I'm really happy to join and be here and help you guys as well, like broaden what we can like value add as services for our clients from a tax perspective as well.
Yeah. And to open that up, I mean, I got a couple of questions. I'll ask this first based on what you just said, and then I'll go to the other about like bringing you over to the side. But tell them so they understand what's really in your mind the difference between tax compliance and tax planning.
Compliance is literally just the act of having to file a tax return, with Internal Revenue Service so that you can show your income. Ideally, not to lose any deductions or credits, and to pay whatever, your amount due is. The tax consulting piece is the active planning, proactive planning on the front end, so that when you do the compliance piece of filing a tax return, you don't pay any more than you have to, any more than that's your share. So I think a lot of times in the CPA world, if people are getting the information to the CPA in February and they don't know anything that's going on, well, there wasn't any active tax planning that they could do. One of the things I learned when I was getting my master's in financial planning was to be proactive. So when I was in practice, we'd work mid-year, year-end especially, to get an idea of what things looked like. So if there was something that could be done by year-end, we could handle it. And or if there was going to be, taxes due in April, whatever it was, we could anticipate it, not have any surprises. I hate April surprises. And then work with David so that we could make sure that the cash was there. You're ready to have the money withdrawn, whatever it is. So that's kind of the difference between, I hope that the tax world is able to lean a little more into the tax consulting piece, but it seems most of it just ends up being kind of the compliance part, which is just the filing of the tax return.
Yeah. Well, and I was going to ask, is that because, what led you to this side of the business, and is that part of it?
Yeah. I mean, deadlines, people probably don't realize there's 8 or 9 different tax deadlines in the year, when you're dealing with corporate returns, not-for-profits, estimated taxes, planning, whatever, maybe extensions. So yeah, I think leading to the side is one, I like the proactive piece. I like, to help clients in their full perspective, not just a little tax pie. And it's a little bit better work-life balance. Also, I typically, tomorrow's a big tax deadline and I would be sweating for all my corporate returns that were due, but I'm not right now. So
yeah, don't tell them that. We work 18-hour days over here at Merritt, and then sleep under our desk and get back up. So there is no work-life balance. It's all about serving you guys, unless my son has a baseball game. All right. So let's talk about some different strategies people can use. One that I saw in chat comes up a lot. When should people consider a Roth conversion?
Sure. So the thing that's tough about it, whether you should or shouldn't do it, is you have to have an idea of what somebody's picture looks like. And it would be great if you have an idea of what it looks like before they actually retired, so you can kind of plan out where distributions would be coming from. So, it's unique to everybody's individual situation. And I think it can always be looked at. I think a good time to potentially do Roth conversions, I think there's 2 opportunities. One is when there's a lull right after your working years, maybe before you start withdrawing Social Security and or having to take your required minimum distribution, so income's a little bit lower, where you could take small conversions each year, and not increase your tax rate significantly. And And the other time would be, I guess, just in general, if you know your tax rate overall, and again, you can kind of take small ones and not bump yourself into too much higher of a tax bracket. I think are kind of the two that I can think of. And you're welcome to chime in too, Dave. It's not like you don't have some tax knowledge too.
No, I think those are all correct. I mean, when you talk about higher or lower tax brackets, and I'm just trying to figure out for myself in my mind, as well as all these clients, there's no right answer here, but when you look at a higher tax bracket in the future, we're set to sunset in 2026. How do you think people should plan around that? Should they plan for that sunset? And at least the way I'm advocating for clients is it's probably not going lower than it is now. I can't guarantee it's going higher, but I'd love to get your 2 cents.
It's tough to plan for because I think we won't really know where it could go until probably beginning to mid 2025 before we have an idea. I don't really see tax rates, though, going much lower.
Right.
For various reasons. But I think it just takes the idea, like really need to kind of plan out, see, one of the things I like, this, we haven't talked about this yet, is having like your retirement savings in diversified different buckets, right? So you've got maybe a pre-tax bucket, post-tax. So pre-tax being, 401k, deferred comp, post-tax or no tax, something like that would be a Roth IRA or a Roth 401k, and then like your regular brokerage accounts or savings accounts, or CDs, whatever it may be. Having those 3 different buckets of income that when you are in retirement, you could pull from them in different ways because they're taxed. They're either taxed in different ways and or not. So I think having an idea of that and then kind of playing and like you do with financial plans, Monte Carlo the situation and have an idea of what you think could happen, and then with taxes, and then go from there. But I think that there's a lot of opportunities to kind of take a look once you have an idea of all the different buckets. What somebody's going to need to have cash flow wise to live off of, and then kind of start planning around it.
Yeah. Well, and since Kat's from the CPA side and I'm from the wealth management side, I'm much more sales oriented. So I will go ahead and say that is one of the biggest things about Holistaplan. It really gives us the ability to almost do like a tax Monte Carlo in a sense. Now we talked about the sunset, and then there's a bigger, issue I see possibly for a lot of people on this call. Certainly compliments to the people I see this with. But one thing that might happen is, the marginal rates don't go up that much, but the estate tax exclusion could go down quite a bit. Can you explain the estate tax to us, how it works? Because I often find people confused about, estate tax exclusions as well as gifting rules.
Yeah, I'll do my best to kind of simplify it. So essentially with the state tax, there's no tax as of now. There's no tax on each individual's estate up to, with inflation right now, I think it's around 13.1 million. So let's say, Dave and I are married and we have $20 million split evenly between each of us with 10 million. It wouldn't be taxable in this current environment. But it is set to sunset with that tax law, the 2017 Jobs and Tax Cut Act that was passed. It's set to sunset and go back down to 5 million with some kind of inflation adjustment. So in that same situation with us, now all of a sudden, if we're got 20 million total, David has 10 million, I have 10 million. Well, now there's 5 million for each of us subject to estate tax. And the estate tax at the highest bracket goes up to 40%, and it's rather quickly. I can't remember off the top of my head. I think it's around maybe over 1 million, but it goes up to 40% quickly. And so I think there is something to think about in those situations. And not just mention, because you said gift tax, they kind of interplay with each other. So there's opportunities to be gifting money to relatives, kids, whoever it may be. And that's tax-free and a way to lower your estate over time if you are over that bracket. And I think for 2018, is it 17 or 18,000? David, I can't remember.
It's one of those.
Okay. Somewhere between 17 and 18,000 that you could gift, and it's by individual. You could gift all your friends, not saying anybody's going to, but you could gift everybody, 17, 18,000, and there would be no tax impact on them or you, as a way to kind of lower it. And I'll just throw out too, when it comes to like grandkids, sometimes this gets overlooked, but you can directly pay for their school, as well as medical expenses. Doesn't matter the amount as long as it's direct. It also won't have any tax impact for them, or you. And again, it's a way to kind of lower your overall estate if you are going to maybe be on that border,
Right.
when it's up around, if it sunsets back down, who knows?
Right. Well, and still, if portability takes place, then you can double
That's
that for a couple. This is very different for single individuals. But the thing
True.
I would want to stress for a lot of y'all that folks don't think about is what is in your estate. So it's not just your investment assets, it's also real estate, it's also life insurance. Not that this would impact many of you guys, probably a few of y'all, but it's personal possessions that may have some significant value. So there's a lot of stuff in there. And, I've dealt with a lot of people, myself, for example, who doesn't have that much liquid net worth, but man, you add life insurance on top of that and real estate, and you're moving in a different direction. So I'm sure y'all see that a lot for yourselves too. Okay, great. So let's jump to some other ideas here. So first of all, you mentioned RMDs earlier, and that kind of, in my mind went to charitable giving. Let's talk about some tax efficient strategies on, if you're giving to a charity, how do you get the most bang for your buck? Whether you're, 70 or 72 or older or 60s, what are some ideas there?
Sure. So again, I'm going to tell you some things. They're going to change in a couple of years, depending on what happens with the new tax law. But our standard deduction did double. 2018 now, so it's around, married filing jointly, around $30,000. So you're not, it's harder for most individuals to be taking itemized deductions unless they have, a lot of mortgage interest. Is probably the only way, because they cap the state and real estate taxes to 10,000. So one thing with charity would be, like, I'm thinking in 60s pre RMD time frame, would be to look at maybe doing some bunching of charitable distributions. Maybe, and again, this is for people who, charitable inclined, but some people want to just tithe every year to church. It doesn't matter how it happens. So this is just a tax strategy with it. But you could bunch it and have, maybe for the next 3 to 5 years, say, okay, I would typically give 10,000 each year. I'm going to go ahead and give 50,000 in this one year, maybe put in a donor advised fund so you could still distribute it out over each year. And that way you get the full $50,000 deduction. It would bump you to be able to itemize that year and be a more tax efficient way to utilize those charitable donations. And then, of course, maybe if there's appreciated stock that you could donate to the advisor fund, that would help too. So you wouldn't have to recognize the capital gains associated with that. And then I guess for once somebody's hit required minimum distribution age, RMD age, it's 73 now, qualified charitable distribution. So you can directly, take your RMD, send it to, whatever charitable donation you want it to go to directly from the account. And instead of you having to take it, as an itemized or standard, as an itemized deduction, you get it right off as income. So it's going to lower your income. I don't know that it's going to help Medicare premium. It's going to make that much of an adjustment, but at least it's going to help income. You're going to get to take the deduction versus, now if the standard deduction, it's been doubled, you might not getting there unless you're bunching donations. So
Golly, you mentioned Medicare premiums, which, now it brings us to the evil witch of Irma. So, what is the relationship between people's taxable income and their Medicare premiums, and how, we really think about it, that's really where a lot of this comes together as far as, what's the impact of a Roth conversion, what's the impact of a donation somewhere, and then how much you pay in Medicare, which, in my opinion, is that significant, but I've heard it from a lot of you guys, and it really bothers you all when y'all
it's
have
because
to
you're not
pay
paying it yet.
more than the minimum for Medicare. So anyway, Kat, I'd love to hear your tax perspective on that.
It's calculated off of your taxable income. So if you can lower your taxable income, that potentially could help with the premiums. Again, I don't know what it takes to kind of get to the buckets. It's also a 2-year look back. So I have seen some surprises with clients in the past where maybe they had a couple of really large years right before they retired and it bumped the premiums up. There is an opportunity, I think, for you to, you can speak better to this than I can, to reach out to them, let them know there's been a life change event in some way to get them to lower it.
Yeah, and I've not seen that work in retirement, but it definitely works pre-retirement going into retirement. So let's say you're 70 and you retired at 65. They're going to look back to when you're 68 and you're just kind of stuck. But if you're 66 and you work till you're 65, you can definitely submit a form telling them that, yeah, the reason I earned so much the last 2 years is I was working, now I'm retired. Yeah, so.
Got it.
Okay. Well, good. Now let's talk some state specific stuff. And it's funny, the people that are sharing their screen versus not, because I see a lot of people that don't live in Georgia. But I know a lot of the people that are on here do live in Georgia, and Georgia's got a really neat exclusion. And so I thought it might be interesting for us to talk about, at least how this could plan someone's distributions, once they're 65 and get that $65,000 exclusion. So give us some insight there.
Sure. And there's a lot of, I know we're speaking specifically of Georgia because we're in Georgia. A lot of states, though, in various ways are tax friendly. And then there's a couple that are not tax friendly for retirement. So various states have different rules. But with Georgia, with our retirement exclusion, up to 35,000 retirement income is excluded per an individual, 62 to 64. And then when you turn 65, it's 65,000 of retirement income per an individual. And so one of the things that can kind of make a difference, one, ideally a good amount of people, and Social Security is also not taxable in Georgia. So let me just throw that out there as well. So an opportunity might be, if you have the ability to split the IRA or be contributing to both yours and your spouse's, since it's individual wise, if you have, again, Dave and I are married, we have $130,000 of retirement income, but it's all coming from his account. Only 65,000 of it is getting the exclusion. The other 65,000 is taxable. But if it's split between each of us, he has 65 and I have 65, we're both drawing from them, then the full 130 is excluded. So there's some little play in that realm too. And I don't know how I'm assuming you probably think through that with working with clients, maybe moving, having spouses put money into accounts, things like that.
If we are with somebody early enough, you can. Once they're retired, it's more about where the distributions come from. But, unfortunately, if you meet somebody when they're 63 and they're retiring at 65, you really can't load it up in the other spouse's name. But I tell you where this does come into play a lot in Georgia, and this is important no matter what state you're in if you think about it. Well, not every state. I mean, it depends on if there's state tax or no income tax. But titling on an account, literally in the state of Georgia, if you have a spouse, whoever's name's first is whose Social Security number those dividends and capital gains hit. So with that, sometimes you want to put the wife's name first. Sometimes you want to put the husband's name first. Sometimes you just want the account in the wife's name. Sometimes you just want it in the husband's name. Most of the time, it's more about having a joint account and just whose name's first on the account.
Hey, so David, this is Fred. Quick question.
Hey, Fred.
So, we had some life changes, and both sides of the parents recently passed away. So my wife, we're currently sorting through stuff, and so she got all the dad stuff, and it's only in her name. So from what I understood, we just need to keep that separate and don't combine it.
Now, you can combine it. Knowing y'all's situation a little bit, Fred, if I put that in a joint account for y'all, I would just put her name first and your name second. That's the key. It's not your name first and her second.
Okay.
I know it's silly, but it does matter.
Yeah. All right. Thank you.
Yeah. All right.
Hey, David.
Anybody else? And then we do have one question in chat here that I thought was really worth getting to. So any other questions? Because we're about done. We're coming up on 12:50, and I want to make sure we have, we're out of here by 1, as well as get to any questions from the field here. So y'all have, obviously just a great expert here in Kat, and please leverage her as well as me for the next 10 minutes.
We lose Kathy?
Kathy Red, was she talking?
We might have lost her. Let's just, I'll be curious. I know Ricky's question about capital gains, and, not getting the April 15th bill. I think some things to say there is, one, the good news is, at least with capital gains, ideally it's a lower tax rate than it would be, typically the ones people are seeing is the 15% or the 20%. I will say that there is the sting of the net investment income tax, which is that 3.8. If you have married filing jointly, they have income over 250,000, their investment income could then be tapped with that extra 3.8. So I think that's a way to kind of think through from a planning side. The one thing I want to say about capital gains, and Ricky, if you have any other kind of like specific questions, we could get into it later, but there's also a 0% tax bracket, and there's a way to kind of leverage that, depending on, again, where the money's coming from, things like that. But it's a 0% tax bracket up to around 94,000 married filing jointly. So that's before the standard deduction. So let's just bump it up. So let's say, if you have 110,000, it's 120,000 total. But you had $110,000 of capital gains in 1 year, and no other income, no other sources coming from, you'd pay 0 tax on it because of that 0% tax rate. So I think there's ways to think about leveraging that. The only thing I can speak to, Ricky, as far as the surprise capital rates, is being in sync with the advisor. So that's one of the things. It was tough. The CPAs just aren't always in sync with the advisors. I think that's just, they're running on different time clocks, but sometimes there's different information that's sourced to each of the individuals. But I think tax loss harvesting against some of those things would be helpful. So, if you know that there's going to be a huge amount of taxes, are there any tax losses to harvest to offset it? Having an idea of maybe what the gains look like in the year, so that, and somebody being able, and the holistic software that we have should be able to help with it now, but being able to give you some kind of plan or idea so you don't get the April surprise. I don't know if that answers your question or not, Ricky, but.
Well, a couple of things I wanted to interject on that also. Everything you said is spot on, but, remember, she did say of income. So if you have no other income, so let's say you have, $120,000 of income between Social Security and pensions, then your capital gains are going to be 15%. But if you have no Social Security and pensions and just 80,000 of capital gains, you owe nothing.
And again, I think that the thought is that if you're working with somebody and can think through a long-term strategy, with retirement, there's different time frames of when people are starting to pull money. And so I think you could think about from somebody's retirement age, early 60s, before they maybe decide that they want to pull Social Security or let it go full term, or even pass up to 70. And then, of course, when they're required to start taking required minimum distributions.
Yeah. And then one other thing, and this is just, so y'all know we're doing it, and, if people have too many questions about it, you can definitely ask them to, see if they want a second opinion on this. But I don't think a lot of portfolios often take into account the capital gains. They just kind of take into account the investment strategy. The number one area I see this in is just mutual funds that people own outright. I mean, mutual funds, those managers have no idea who's invested in it. And unfortunately, they can be pretty nasty from the standpoint of, let's say you bought a mutual fund in 2022 and you sell it in 2024. Unfortunately, along the way, you might have to pay capital gains on stocks that manager bought back in 2015, which can be really nasty. Because you weren't there to benefit from, that 2015 to 2022 appreciation. And so a lot of times, even if it hurts your return using things like ETFs sometimes not placing trades we would in a IRA, sometimes making sure your fixed income's over in your IRAs and then not, in the taxable accounts. And so I would use the word asset location. It's not necessarily just what we own, but where do we own it? So where are those mutual funds located? Where are those bonds located? Where are the equities? Where are the ETFs located? And we definitely try to do that. I'm not sure a lot of people understand that we're doing that, but it's definitely present.
And I will say that I don't think a lot of other advisors do. A lot of other firms. I've seen at least on the other side, and it's kind of just willy-nilly. It's kind of just an easy way for their model to work, but they don't really strategically think through some kind of tax advantages between this being held in a regular brokerage account versus this being held in an IRA. Sometimes they just hold it across all of them. And I think they have the reasons for that, but the tax side is not always the most strategic.
Correct. And remember, it's not how much you make, it's how much you make net of taxes, because that's how much actually a better way to phrase it, because we can go back to asset protection, which we did earlier this year, which is, you've made your money, let's be sure to keep it. It's not how much money you have, it's how much money you can keep. Because there are a lot of things that can take your money away from you, right? And many of us have experienced those. Taxes is certainly one of them.
Yeah.
And then I am seeing, I don't know if that's a hand raised or if that's a wave, but Ed, did you have a question or are you just waving at us?
No, I have a question actually, Dave. Can you hear me okay?
Yes, sir.
As you remember, we invested some of my IRA in a structured note a couple months ago, and I take a monthly income from that. Does this monthly income count toward my annual RMD?
Yes, your monthly income counts from your annual RMD. The structured note or any investments inside of an IRA do not impact any taxable events. So when you think about an IRA, the only thing you're paying taxes on is the money that you distribute.
And the second part is, could some of this monthly income be funded into my Roth, my existing Roth?
Yes, and I would recommend at this time of the year, we get your 2023 taxes and then put them in that Holista plan and then run an analysis and maybe do because it's not like it's a direct feed, it's actually called a Roth conversion. Maybe around May or June, do one of those after looking at that. But yeah, you absolutely could.
Very good.
And
That's it.
When people think of Roth conversion, I know it's the income piece. I'll just throw out there that it also from an estate planning for your heirs is thoughtful, right? Because a Roth isn't going to be taxable to them. And I'll give it just a personal example of planning that happened in my family. Is my dad, it was important for him to leave a little bit of a legacy for me. He also wanted to take care of his wife, my stepmom. And originally he just had everything split 50-50 between all his accounts. And this is with the change in the Secure 2.0 Act. But because of that, he made a change where and it worked out because they're kind of even. We're now, I'm the beneficiary of his Roth accounts. She's the beneficiary of his traditional IRA. That way, because she can still take the spousal benefit and take it over the course of her life versus, the having to take it in 10 years. So I think there's planning to also be done there through your heirs too, because it's about the money you keep. It's about the money if you want it to go to your heirs, what they're getting as well. And so I think that there's planning in that world too.
Well, hey, we're coming up on time, but we'll certainly bring you back. And heck, guys, next month I might be in Hawaii and let Kat do this whole thing. We'll see. But you mentioned Secure 2.0, so just let's talk about how that has changed. What happens to a IRA when people inherit it, and then we'll go ahead and wrap up. But I'm sure there's we could stay on if there's questions. But yeah, keep going.
We could stay on if there's questions, or you guys could just all email David's, and just take up his email box.
kgreer@meritfa.com.
Okay, so for Secure 2.0, that change, it came through at the beginning of January, I guess, right pre-COVID, right? I can't believe that's 4 years ago. Where you used to be able to stretch what they call stretch an IRA, where if you had, you know, a child who inherited it, they could take it over their lifetime, based on the IRS tables. They took that away. And so now you only have 10 years. So, and this is a traditional, IRA, not a Roth, where they're going to have to withdraw it all in the 10 years. And so that can impact what they think is income, you know, coming in. They're going to have to pay tax on it. So I think, again, long-term Roth conversions also play into that as well. Did I answer I'm thinking if I got all the parts of the Secure 2.0, that's the major part of it, is just,
Yeah, the
it
10
really
years
changed,
is interesting.
it changed the game about how maybe you were gonna want to leave finances to heirs. You know, we've seen some people who are switching and having, if they wanted to give to charity, and their estate, changing to where maybe their Roth, I'm sorry, not the Roth, that their traditional IRA is part of it's going to the charity, and then taking, you know, the cash, the real estate or land, you know, Roth accounts, and having that go to the children's, because there's less of a tax impact, right? Real estate's going to be stepped up, to fair market value. Cash is this, you know, whatever the same it is, and the same with stocks, they'll be stepped up. And then Roth is non-taxable to them. So